What?
We gotta record a video
Oh, what?
about whether you should pay off your debt or invest in your 401k.
Oh, okay. Ready.
Let's do it.
So is it better to pay off your debt or save money?
So that is the question, and we're going to jump in so that you know which one you should do and when. Should you save first before paying off your debt? Should you pay off all that debt before you start saving any money? You want to make the right choice so that you end up in the best position financially you possibly can. Hey YouTube, welcome back to Owen Your Future and Money Tips with Matt and Allie. If you like financial content, stuff about travel, paying down debt, saving and investing, make sure to like this video and subscribe to the channel so you get notified every time new videos come out every Wednesday.
Never miss Money Tip with Matt and Allie. So we had a subscriber question and her name was Carla. This was changed for security purposes. Carla wrote into us asking if she should pay off her debt or save for retirement. So we're going to give a little details about Carla's financial situation and we'll go from there.
Yeah, so Carla told us she has $3,000 on a credit card with an interest rate of around 20%. She has another credit card with $4,000 on it with an interest rate about 16%. She also has a car loan, $12,000. She has 2% interest on that car loan.
$30,000 student loan balance at 9% interest. $120,000 balance on her mortgage at 3% interest. Her take-home pay is about $4,000 a month. And she currently has no emergency fund saved, but her 401k at her company matches dollar for dollar up to 2%. Yeah.
She hasn't been contributing to her 401k yet, and that was really why she wrote in, was to figure out, should she be investing when she still has all this debt, or is she supposed to pay this debt down first before she starts investing in her 401k?
And the questions specifically that she have for us are, should she be investing in her 401k? Which debt should she pay off first? Should she save up for an emergency fund? Should she pay her home and her car off early?
Yeah. So there's a lot of differing advice out there. So it's not too surprising that Carla still has some of these questions, because as you browse around on the internet, you're going to see a whole wide range of advice. So people saying you should save $1,000 in an emergency fund before you start paying off any of your debt. People saying you have to pay off the highest balance of your debt. Other people saying you should pay off the lowest balance. Other people saying you should pay off the highest interest rate balance. It's all over the place. So really, we're going to start with the first question, was whether she should be saving in her 401k or not.
So before we give advice, we were curious, comment below what you would recommend to Carla's in her situation, and we'll see if it lines up.
Yeah.
So first question, should she be contributing to her 401k? What are your thoughts?
Yeah, so I definitely think you should be, and we'll have a little bit of a caveat, but basically the company is going to match your money. In her situation, it's the first 2% of her annual salary that she puts in. So basically by putting that money in the 401k, you get a 100% return on it.
Yeah.
Because you get free money, basically. And
you don't see that kind of return very many places.
No, and we talk a lot on our channel about interest rates and how to kind of compare things, and we make a lot of our decisions that way because it's the mathematically optimal way to either make the best return or spend the less in interest. So in this case, you're getting 100% return by putting at least up to the match in the 401k. I wouldn't really recommend that she puts any more than that in at this point in time.
For sure. And if she can't make her minimum payments, then what would you say to that? Like her minimum credit card payments, if she can't make that every month.
Definitely. So that was the one caveat. I don't think I would recommend Carla to put that 2% in if it was going to cause her to have late payments, have missed payments. Obviously with credit cards, that comes with fees. It also hurts your credit, which could hurt her refinancing her student loans down the road or something like that. So definitely going to encourage her to reduce her expenses as much as possible, try to increase her income in any way she can, whether that's picking up gig economy work or doing something on the side maybe. That'll help widen that gap between her expenses and her income. And then she'll be able to make her minimum payments and contribute to the 401k. So the second question Carla sent us was whether which debt she should pay off first.
So our method is not the snowball method. It's not the tsunami method. It's the tornado method, which we've talked about in previous videos. We'll link above. So in our tornado method, we recommend paying off the highest interest rate debt first. So that would be her credit card with 20%. Then she would go for her second credit card at 16%. And then she would go for those student loans. So that's the way we recommend doing it. In our Own Your Debt course, we have an entire module on mindset, because getting your money mindset and understanding your past habits and patterns around money will enable you to be successful at the most mathematically optimal principle. Methods like the snowball method work because it's a psychological trick that you play on your mind, basically. And so we try to address that first, the psychology behind money, and then go into the most mathematically optimal way.
Definitely.
The next question she had was, should she save up an emergency fund?
This is a good question too, and one we've covered before in one of our videos, but where we stand on it is that you shouldn't really be saving in an emergency fund while you still have high interest rate credit card debt. So we say not until your credit card debt is paid off. And we want to go into some more detail and explain that, because I know it's kind of counter to a lot of advice out there, and we'll explain why. But first, we need to talk a little bit about types of credit, and we're going to talk about revolving credit versus installment credit. So revolving credit is credit cards, personal loans, things that you pay on every month, but you can also take money back out of every month. And
It's like a door, revolving door.
Exactly. Think of it that way. Like money comes in and back out on a consistent basis. And installment debt is more like your amortization on your house. Like you have a payment every month that will pay this debt down in 30 years. And once you make that mortgage payment, you can't just be like, hey, mortgage company, can I have that $500 back this month? I need to pay for something.
Yeah.
So the reason we make that distinction is that with revolving credit, typically it has the highest interest rate because it's usually not secured against anything like your home. And when you have that high interest rate debt, saving money in an emergency fund, you're charging yourself interest on that balance that's on the credit card, which you could pay off with this money you have in your bank account. So you could save yourself that interest. But when you have it in a bank account, it's sitting there earning hardly anything. So we recommend if you have that type of credit, revolving credit, you should pay that money on the credit card, save yourself the interest. And then if you have an emergency come up, an unexpected expense, you can always get some of that money back out. So using that credit card as that emergency fund while you have credit card debt. Now, we make a very clear cut there, because you don't want to be taking money off the credit card to pay for unexpected expenses when you've put your money into like an installment debt or a lower interest rate debt. So in Carla's specific situation, I would say pay your 20% credit card, pay your 16% credit card without having an emergency fund. After that point, establish an emergency fund and then start paying on your student loans. Because at that point, you don't want to go into credit card debt because you'd put money on your 9% student loans. That you can't get back out to use in an emergency.
Yeah, that makes sense. Totally. So if she were to not save an emergency fund in between paying off her credit card and her student loans, let's say she just went straight into her student loans. So in order to keep paying down that student loan aggressively, if an emergency came up, she would take money from the credit card, right? Which is she's paying like 16% interest on. Which wouldn't make sense mathematically, because she's paying down this 9% interest rate debt with 16% interest rate debt.
Right. That's exactly right.
Sorry, I just really like him saying I'm right.
The way you think about it is you never want to loan money at a higher interest rate to pay money at a lower interest rate, which is basically what you're doing if you're holding an emergency fund while you're paying 20% interest. You're holding money at a 1% maybe interest
Yeah.
rate that you're earning, but yet you're paying 20% over here. So you might as well take this, pay this off, and then if you need it, you can borrow money at the 16% as you're paying money at 16%.
Right.
So it's
that
kind of
makes
break
sense.
even.
Yeah. Yeah.
So you've gotten yourself into this break-even interest rate situation instead of this big discrepancy between bank account and credit card.
Yeah.
But exactly once you go to installment debt,
Yeah.
you can't take money back off. So once I put money into the student loan at 9%, I can't borrow it back at 9%. I have to then go to 16% and borrow it. So now you're in a better situation to have this discrepancy between 9% and 1% of your bank account. Your bank account's the buffer keeping you out of 16% credit card debt.
Yeah.
So that's kind of the way I like to think about this like interest rate arbitrage, which is kind of what we're doing in order to pay off your debt the fastest and also save yourself, the most interest payments along the way.
Totally. So that goes into her next question a little bit about should she pay off her house early?
Yeah. So definitely after she's tackled all of her other debts,
Yeah.
you end up with a house, which for her mortgage was like 3.5%,
Yeah.
which is pretty low. And at that point, you start asking the question whether you should be investing in the stock market or something else instead of paying off your house. So I'm of the personal opinion that you should invest it at that point instead of paying off your house early, just because you have a really low interest rate.
Yeah.
But I will say this is definitely going to depend on each individual because it comes down to your risk tolerance.
Yeah.
The stock market's returned 7%-ish over the
Historically, yeah.
long run. But when you look back, that's not a straight line. It's very up, very down. So over a 30-year period, you might earn 7%.
Yeah.
Versus your house's 4%. But during that time, it's going to be up and down. There's going to be times where you could be, way worse off than if you'd paid the house, and times you'd be way better off than if you'd paid on the house. But some people are more comfortable with taking that 3.5% guaranteed return on their money by just avoiding that mortgage interest by paying it off early.
So it's all personal, like depending on if seeing those, up and down of the stock markets really stress you out and you don't like that, then go for it. Pay off your mortgage early.
Definitely. And I mean, it can be a really good feeling to be debt-free, right? And if you've paid off your house, you don't have that obligation anymore. You don't have a mortgage payment. Your expenses are more manageable. So that can have a really freeing effect on your mentality and just kind of your financial security. So definitely there's some benefits there to consider.
I would say we are like moderate risk tolerance. Probably moderate to conservative sometimes, I think.
But we have a house that we're now renting, and we don't pay any extra on the mortgage. We plan to let, the renters pay that down for a little while, and then if we keep it, we'll keep renting it, or we'll end up selling it. But, we didn't make the choice to really make any additional payments on that. We decided to invest instead, because our mortgage is 3.5% interest for 30 years.
Which is awesome.
Yeah.
So, that also similar response to her question about should she pay off her car early. Her car's at 2%. And it depends on her risk tolerance, for one. But I would also recommend looking into selling that car and buying a cheaper car. Because you have to think of, like, on a more expensive car, you're going to have higher insurance payments as well. So if she were to sell that car, get a cheaper car that she could pay in full and have just liability insurance on, she would be saving money in the long run. Or if she wants to keep that car, if that car is her baby, she could keep that car and just run it to the ground, basically.
Yeah, I would say definitely pay it off and then keep it for as long as you can after it's paid off before, buying another one.
Yeah.
But I would say that's the same discussion, except for now you're talking like a 2% return on your money, which is pretty low versus investing. So
leave us in the comments below if you agree with us or what you would recommend to Carla to do with her finances. And
for sure, if you guys have any questions, money questions, or if you have a specific situation that you'd like us to look at, feel free to leave those in the comments, or if you'd rather email those to us, we definitely change any information, so feel free to do that. And we would love to take a look and see how we can help you.
And if you liked this video, and if you're new here, make sure to hit subscribe and never miss a money tip with Matt and Allie.
Like, other than my